Good morning, traders. Paul here with GammaEdge. Today is Tuesday, the 7th of June. Let's get started. So the fine print asks that everyone pause their player. Read this. Important to you. It's important to us. Starting with the market model, cumulative tick, 2 days of starting to deteriorate. This is the ARCX, which is what we call the quality cumulative tick. There's also the USC, which is the US composite, which we consider the trash can. Both are relative in importance, but this one we put more importance on. We're seeing the short-term cumulative tick drop day over day. So Friday, Monday, we're very, very close now to re-entering the top of what we call the ribbon. The ribbon is a long-term moving average of the cumulative tick and has been a good line in the sand or demarcation of whether we should be bullish or bearish. The cyan line above the red line indicates that we are still in a bearish condition, and the positive slopes indicate that we are improving into a bullish condition, but we're not there yet. We're not in a confirmed long-term bullish condition. If we get a crossing of the white CT into this area, that'll be a nail in the coffin for the bulls, and a break below the ribbon and a continuation downward, where you can see a downward railroad pattern starting to develop here. We call these the railroad tracks. If we continue this path south, the bull will be dead, and we should be positioning accordingly. Looking at the index condition on the SPX, the SPY, the Qs, and the IWM, pretty much a mixed picture. We're seeing some short-term negative gamma being added in the SPX, but we also saw some calls added, and that actually pushed the zero up a little bit, which is not a big change from 41.05 to 41.15, but it's there. The SPY, we had a slight drop from 41.415 down to 412. We saw this actually is a drop in positive or negative gamma, which is interesting. And we saw an increase on the call side. So this is bullish. This is mixed. Mixed over here for the Qs. You can see that we have this battle going on, this contention of negative gamma being added as well as positive gamma, which is a rotation. Same thing over here on IWM. So just be aware, very mixed, very messy picture, no real directionality in the index conditions. Near-term expiries, I've highlighted where we are in relative to the zeros. The black dot indicates the spot price at the close yesterday. Important to realize we are very close to these zeros. When we are close to the zeros, there is no dealer pressure. I know this is the same tag that we had yesterday, and it applies. We saw very little pressure yesterday. We're seeing very little, probably going to see very little pressure today. So just be aware of that. Taking a look at the gamma history, a lot of verbiage here. Pause your player and read this. The key takeaway is that we're somewhat bearish on the SPY. We're actually not advancing, and you can see we've got some downward slope on the gamma levels. Very, very tight range on the Qs. And for the most part, we're remaining stationary, maybe a slight upward bias to the short term or small caps in the short term, but net, especially with this being such a small volume, we are short term down or short term bias down on the SPY. Taking a look at the SPX, some questions came in. I urge everyone to go to the Discord questions channel. I answered how do we really infer low pressure environment versus a high pressure environment for the dealers, and it's largely based as a starting point on this. This is more or less the same picture we had yesterday. You can see we've been playing in the same tight range. Each of these white horizontal lines is a true gamma zero or true delta zero, and while we're in this flipping zone, we're not going to see a lot of pressure one way or the other. Contrast that with what I put in the Discord channel in the answer, where I showed some examples of some high pressure environments. We're not there. So I think intraday dealer movements will be just reactionary to whatever retail does. The adjustment amounts are going to be very low on both the gamma perspective as well as the delta perspectives. Everybody's pretty flat, and as a result, you can see where some of the lines in the sand are 4,000 to the downside, 42 to the upside, and between that is going to be relatively noisy. Taking a look here at the 0 DTE, clear transition point sitting here at 4110, 4115. I want everyone to be aware of that. Here's the 4100 expiry today, removal of this, and all of this gamma down here is going to change the overall structure going into tomorrow. But remember, Tuesday, Thursdays are incredibly weak. We, again, just like yesterday, we were at minus 2,000 contracts yesterday, which is nothing. Today we're at minus 1,000, so it's even less. So I'm expecting more of the same. If we push towards 4,200, you can see we've got a little bit to get through here. The key takeaway for everyone in the overall expiry is that above 4,200, there's not a lot of pressure to advance rapidly due to the 0 DTE, so I'm not expecting a lot of DTE pressure today. On the SPX, which is the AM plus PM, we do not include the SPY in this presentation. This is just the SPX. This is all expiries. The key takeaway, still very, very much net negative. You also saw that in the gamma, in the wing charts, where the red wing is dominant over the green wing. Very, very high amount here still. It is improving. We were more negative yesterday than we are today, going into today. So we are seeing some calls being added and puts come off. That is constructive. A lot of negative delta still above us. It's going to be really hard unless we get a 0 DTE event today, which adds a lot of calls to negate this. It's going to be very, very difficult to push upward. Just everyone be aware of that. So 42 sitting here. And you can see some of the delta levels here are fairly significant. Gamma levels turned negative below, not surprisingly, where we ended the day yesterday. This is the transition area. You can see it's back, forth, back, forth. This is not a surprise. We see this all the time, and you can see the key levels at 4,100, the Livermore, again, on the quarter levels, 25, 50, or 75, 50, and 25, all the way down to 4,000. 4,000 has an extremely large delta support level, and you can see COI, call open interest, and put open interest dominating here. Watching the expiry for June, you can see there's still quite a bit in play here. Approximately 30% is coming off between now and the end, and the monthly expiry. That is a big chunk of the SPX. So the crystal ball is basically saying if we do take 4,200, I don't think we're going to go there fast, but if we do take 4,200, the next upside targets is JPM level up here at 4,285. JPM has got a number of long calls sitting up here, or long puts, sitting up here, which has given rise to this negative value. You can see those. There's 44,100 that JPM owns, and then a whole bunch of people, of course, are copycatting that. That will be a tractor pinning level because of the transition, just the magnitude that is associated there. We're going to want to see some of these deltas change before we can get up there. Taking a look at the expiration, flat here, very low pressure. We're relatively unchanged on the monthly, relatively unchanged on the end of month, and I added into July so we can start watching that. The structure hasn't really changed from yesterday. We're still at the base of the transition zone. You can see, though, there has been some growth to the 4,200, even though we're still down here in this area. Typically, gamma drops day over day on the put side and has been increasing on the call side, and we are, in fact, seeing that. We're seeing this drop day over day on the put side and increase in the call side, although the zeros are remaining fairly stationary. We went from, I think, 8.6 thousand contracts, so 8,600 contracts up to 11,000 contracts now at the 4,200 strike, and we'll want to pay attention to that. Here's the JPM up at 4,285. If we do break above these key ranges that you see here, especially the 4,200, you can see that we could start pushing north into the 4,275 layer here. A lot of open space between here, so the run up, if the deltas can get adjusted out, we could actually see a good push. But in the short term, I'm not anticipating it, and I'm not playing it in that way right now. So the summary for today, we are remaining within the zeros in that transition zone. We're in a low pressure environment. From a dealer perspective, we're not seeing strength. In fact, we're seeing the decrease on the cumulative tick. Break below the 4060 level to the downside, and the 4167 to the upside are the key levels to watch. We start getting those areas, it'll be interesting. I do think it's going to be more difficult to move up than it is to move down. The market model, longer term, we have a positive slope, but it's slowing. This is leaning more bearish on the longer term, meaning we're more imminent of a failure here than a rise to the upside. Hopefully I'm wrong, but hope is not a strategy. To the shorter term, breadth is still poor. Didn't really discuss that today, but for those of you who watch that with me, you'll see that we're not in very good shape there. Although we are above the moving average ribbon, we are below the short-term moving average white ribbon, and watching that is going to be important. We want to see a rally to the upside. We want to see that white ribbon invert and the cumulative tick push higher. We're not seeing it. We're actually seeing it all pull back. If you don't understand what I'm saying, go back to that market models chart and take a look. It's pretty clear there. The wing charts, this should say from Monday. Sorry about that. Monday are mixed, and they're not supportive of an aggressive move upward. We are seeing that rotation again. We do believe the 4100 is important. We've got a number of things sitting there, and it is a Livermore level. If we do lose 4100, we think we're going down to 4060 would be the first short-term target, which will be the bottom of the zero transition zone, and below that 4000 is the line in the sand. Downside, we're seeing growth on the downside puts. Expect charm, which is the decay due to time, into the monthly OPEX to start offsetting that JPM 4285 boat anchor. So JPM, just be clear here, we've got some positive delta adjustments that would be required from the dealers from this due to all those puts below us. But then we've got that long put above us, and that becomes a headwind as the dealers sell, as they become more in the money with this long put, or as retail becomes long and they're short those puts, so they have to adjust for that. So that's it for today. If you like today's content, or any of our content for that matter, come join us at GammaEdge.us. That'll take you to a sign-up page. 14-day free trial, all the tools turned on for you. You get to come in, meet the group, see how you can apply this stuff to your trading style. Learn a lot about what we do and how we're applying this to our trading. Follow us on Twitter, please, at GammaEdges with an S. And then, of course, here on YouTube, if you liked today's content, smash that like button, smash it hard, and subscribe so you get notified of the next time we post something. So with that, I bid you farewell. Thanks for your time. If you made it this far, we'll see you in the Discord, and good luck for the remainder of the week. Take care.